Browne. Welcome to MFB News. Hope everybody is really well. I'm just recovering from a night last night spent at Lords watching the 100. It was absolutely brilliant fun, actually. Really accessible way to watch cricket. This is totally not relevant to the video, but just as an aside, if you ever fancy going to watch some good quality cricket, going to the 100 could be a really good way to do it because the tickets are way cheaper than if you were to go and watch, for example, England play. And I don't know how many of you saw the footage on TV, but we had the bonus feature of a fox on the pitch, which was very exciting. Anyway, I digress. Let's talk about mortgages today, because that's what we're here for. And what have we got for you? We're going to do our usual run up down on what's been going on with swap rates, the expectations for base rate when the MPC meets tomorrow on Thursday. We're then going to be having a look at lender pricing changes, some lender criteria changes, delving a bit more deeply into some of the criteria changes actually, because I think some of the feedback we've been having is that actually you guys really like it when we talk about criteria changes, why lenders kind of take certain positions on things. You know, one of the questions we often get asked actually is, but why don't they want to, lend in this situation? So kind of getting a better understanding there. And then finally, we're going to take a bit of a deep dive into what's going on in the housing market, particularly useful, not just for those of you who are thinking about either buying or selling, but actually, let's be honest, for those with a property portfolio, we're all interested to know what's going on with the property values there as well. And also how this is going to knock on to rents. Okay, so first up, swap rates. I mean, things are really stuck at the moment. I feel like we've been at the sort of same kind of level for absolutely weeks now. Now, on one hand, we could argue that's bad news because it means rates aren't coming down. On the other hand, let's just think about the mini budget. There's a lot to be said for rates actually staying still and not going up as well. So there's always a silver lining to every cloud. Now, in terms of where we are, so 2-year swaps are 3.57. 1 month ago 3.99 and 1 year ago 4.0. So actually both month on month and year on year on 2-year money, much better place. 5-year swaps currently at 3.61. 1 month ago 3.63 and 1 year ago 3.57, so kind of almost no change, not just month on month but year on year as well. And what does this tell us? Essentially what they're saying is that the long-term outlook for fixed rates over a 5-year period, the position hasn't really changed. Now we have seen a little step down in swap rates compared to last week. So last week they were about 3.7 for 5 years and now they're at 3.6. For those of you who are interested in kind of the stuff that goes into this, the slight step down in swap rates this week was due to a improvement in gilt rates, and this was in the news of the news in the America in the US, sorry, with regards to their job market. So they've got many less job vacancies than initially thought. So essentially, the job market in America is weaker than initially thought, and that meant that kind of then floated across the pond, as things always seem to do, and made our gilt rates a bit better, which in turn has fed through ever so slightly to swap rates. So this is the kind of stuff that's going on all the time in the markets, and that's why you do see things bouncing around a bit. But actually, in terms of week on week, month on month, and even year on year, particularly for 5-year swap rates, no changes. Okay, now MPC tomorrow on Thursday, and so what's going to happen there? So there's an 80% chance of base rate going down by 0.25%. That's been priced into the markets. So essentially 80% of people in the city who are kind of doing these pricing things have already said that actually base rate is going to come down by 0.25%. So what does that actually mean? So first of all, if base rate comes down by 0.25% tomorrow, anyone who's on a tracker which is directly linked to Bank of England base rate or a variable rate directly linked to base rate, you're going to see your payments or your interest rates, come down by 0.25%, which is happy days. The bigger kind of thing here is the number of people that we're speaking to who are saying, I'm just going to wait and see before booking a fixed rate what happens with base rate in August, which is absolutely fine. And people are obviously very entitled to make those decisions. But here's the thing, right? The reality is that because the markets have already priced in an 80% likelihood of base rate coming down by 0.25% in August, if base rate indeed comes down by 0.25%, actually what people thought was going to happen has happened. And therefore that's not really going to have any material impact on swap rates, and therefore fixed rates are unlikely to change much at all. So what would change the dial on fixed rates? So first of all, if base rate came down by 0.5%, that's a notable difference. So that would have an impact and bring down fixed rates by a little bit. Conversely, if base rate were to be increased or stay the same, that would then have a negative impact on swap rates. So I think realistically, actually, for those people who are kind of thinking, I'm just going to wait and see what happens with base rate, it's a really valid point. I totally get why people do this, but actually you are exposing yourself to risk rather than kind of giving yourself protection. And the reason I say that is because the markets have priced in an 80% chance of swap rates, base rate coming down in August. As we've talked about in previous weeks, there's a lot of things that go in the balance in terms of the MPC's decision in terms of what they're going to do with base rate. In the favour of base rate coming down, we've got things like the economy not performing well at all. So actually drop base rate down, stimulate the economy, get things going. Conversely, inflation is still running hot. Unemployment is doing relatively well. Pay is still increasing. Admittedly, the rate at which it's going up has slowed, but it's still increasing at a rate which is above where people would expect it to be. And so therefore, there's actually a kind of real tension in terms of kind of where the Bank of England should go. So there is a chance they could actually not reduce it. And therefore, the predictions about what's going to happen with base rate going forward over the next 2 or 5 years, which therefore leads into pricing of fixed rates, has to change adversely. And therefore, you could find that actually swap rates move up a little bit. So actually waiting for base rate to happen isn't necessarily the most sensible thing to do. So how can you protect yourselves from these? So the advice that we give to our clients is, look, when you submit a mortgage application, once the application is fully submitted, the rate is booked for you for a period of time. It's normally sort of, it varies from lender to lender, but let's say around 30 days. So if you made an application in the middle of July, the rate is booked for at least 30 days to get to things moving. Actually, once you get your mortgage offer, your rate is valid for between 3 and 6 months. So you have kind of windows of time in which you are kind of reserving the interest rate without actually committing to anything. If the fixed rates come down from that lender during the mortgage application process, and indeed any point before completion, most lenders will let you move on to the new lower rate without any charge. So my advice to my clients is always very much this: book a rate now. It's a worst case scenario. If rates do come down, actually we can move you on to the new low rate, no problem. But what this does do is protect you in case interest rates actually start to increase again, which, as we know, over the last few years, the one thing we know for certain is that nothing is certain. So actually getting yourself in a nice secure position is a really, really good idea. Okay, so sermon over there. This is one of the things that I just talk about so often with people, because it really, really worries me that people are trying to do the right thing and it ends up costing them money. And I just think that's really, really sad, because ultimately we're all just trying to kind of get by at the moment. So to be waiting for something to happen and then find that you miss out and it's going to cost you more money is just really, really sad, particularly when it wasn't necessary for that to happen. So apologies if I'm always labouring the point, but as brokers, we're the ones who have to speak to clients and say, oh, you know, base rate didn't actually move and I'm really sorry, but that rate that you were thinking about taking has now increased. You know, it's actually not nice to have those conversations, and it's certainly not nice for the borrowers who are the ones who've been paying the higher interest rate. Anyway, right, moving on. So in terms of lender pricing changes this week, we have seen some rates moving downwards, thankfully. Nothing too exciting looking at my list here, but nonetheless nice to see a bit of moving around. So first of all, Landbay have reduced some of their rates by up to 0.1%. NatWest have reduced rates by up to 0.3%. That's pretty punchy at the moment. Santander have made some rate reductions, as have TMW, by up to 0.15%. Leeds have dropped rates by up to a whopping 0.06%. The Family rates down by 0.05%. Molo have reduced rates by 0.06%, and Holiday Let rates have come down by up to 0.5%, and Paragon have made reductions of up to 0.1% as well. So you can kind of see how the market's performing. So take out the outliers there of NatWest at 0.3, because they were clearly just overcharging. They were actually sourcing incredibly well. So if you did a rate comparison maybe 2 or 3 weeks ago, NatWest have been coming up sort of very, very high. To the top of the table, basically. So I'm using jargon with you. So very competitively. And so what's probably happened is that they've just had a rush of business. They've pushed their rates up a bit just to kind of stop being the top pricing bracket, to sort of slow things down. It's always very hard for lenders trying to find this balance between driving in business but not getting too much business, particularly in the holidays when a load of staff are going to be off, you know, on break and stuff. So I don't think NatWest reducing rates by 0.3 really signals anything to us other than they're kind of stepping back to the table again. So nice to see some pricing come down. As mentioned, swap rates are kind of just stuck really at 3.7, 3.6, that kind of mark. So actually there's no real reason for lenders to change their pricing at the moment. But as always, as this changes, we will keep you posted. West One have made a little flurry of changes to their lending criteria, and I just wanted to run through these with you because actually each of them are fairly, they're all things that we come across a fair amount actually. So the first one relates to credit scoring. And essentially what West One are doing is saying that they're now able to consider applicants with CCJs. And the CCJs, the one thing that's consistent is the value of the CCJs, which is £250. So if there's a CCJ for £250 or below, West One could be an option for you. Anything over £250, there's other lenders out there, don't worry. But the reason I want to talk to you about this just momentarily is because we are certainly seeing a sort of mild uptick, I would say, in terms of people with blips on their credit file. Now CCJs are something where a county court judgment is where there would have had to have been a kind of trial in front of a court essentially, where a order is written saying by the judge saying that essentially you the borrower owe this particular company or person some money and you need to pay it back. CCJs crop up more often than you would think, and actually what's really incredible is the number of CCJs that landlords can have where they're not even aware of it. So say for example, tenant moves out of property, landlord takes on all the kind of utility bills while the property is void, and then something crops up. The landlord then hasn't notified the supplier to be contacting them at their home address. They're still writing to the rental property. New tenant moves in, posts are over for landlord, tenant looks at it, throws it in the bin. Landlord never gets the notification they've been taken to court. Court hearing happens and suddenly the landlord's got a CCJ and they didn't even know it was kind of coming over the horizon. So this is, like I say, it's not like rife, but it does happen more often than you'd think. So actually, you know, the fact that West One are now able to consider small CCJs is actually a really, really good thing. Are they the only lender? No, but lots of lenders won't lend. Now, the key things with CCJs are as follows. When did it happen? How much was it for? And has it been satisfied? So the first thing is, if your CCJs are unsatisfied, by and large, you're really going to struggle to find a lender to lend to you. So the lenders do want the CCJs to be satisfied. Why is this? Because actually what they're saying is a judge has clearly said you owe these people money and you haven't paid it back. You need to sort out the money that you owe before you come to us asking to borrow money. So CCJs being satisfied is really important. Now, it's not an essential. So as an example, West One is saying that they're going to disregard unsatisfied CCJs and defaults up to 250 quid, but they're going to put you on their most expensive product range. So there is kind of flexibility on this, but just know that you need to satisfy your CCJ. The amount of the CCJ is really important. So generally speaking, small CCJs, like £250 or below, a lot of lenders can kind of wrap their heads around, but we do come across clients who've got CCJs for tens of thousands of pounds. These tend to be disputes over invoices. So, a supplier, for example, or a legal argument, or an argument with their accountant, rather. So these kind of larger CCJs tend to sit here. The larger the CCJ, the harder it is to place the mortgage, essentially, but also always there's a home for most people. It's rare we can't place a case based on the credit profile. And the last thing is when it happened. So a CCJ for 75 quid that was registered 5 years ago and was satisfied shortly after. Most lenders are going to be able to take a view on that. If you've got a CCJ, which was registered 2 months ago, it's unsatisfied and it's over 250 quid, things are going to be a lot more challenging. So that's the first thing on West One's credit. Now, the next thing that they've mentioned is that they're able to do day one remortgages against open market value up to 75% loan to value, subject to plausible evidence and comparables. So what they're saying here is that actually if you buy a property on the 1st of August, you can remortgage it within the first 6 months of ownership, which some lenders don't do, most do these days, but there's still a good contingent who don't. And we're going to lend against the open market value of that property, providing you can demonstrate to us why the property is now worth more than you paid for it. So this is something we find a lot. So the main example here would be, which is a very, very common practice, investors buy a property at one value, they do a bunch of work to the property, and then it's worth a higher amount. And at that point, they want to remortgage it against the higher value, get as much of their money they've invested doing the property up, back out so they can go again. So West One would be able to help you here, but I mean, there's also lots and lots of other lenders who can do this for you. Where it becomes more tricky with day one remortgages is if you have bought a property, done absolutely nothing to it, but you've seen an uplift in value, because the question is always going to be for the lenders, well, how come you're able to buy it so cheaply in the first place? And arguably, if a property is only worth what someone's willing to pay for it, if you paid £100,000 for it 2 months ago, you've done absolutely nothing to it, you're now saying it's worth 150. Why is it worth 150 when 2 months ago the only person, the value of that property was essentially 100? So this can be a bit more complicated. Now, there are a couple of lenders who are able to take a view on stuff like this, but the majority of lenders who do day one remortgages will actually want you to be able to demonstrate how you've seen an uplift in value if you're saying there has been one. There are people actually who just buy a property with cash, and then want to refinance it later. They buy it for cash just to kind of get it done quickly. They're not asking for an uplift in value. They're saying it's still worth what they've paid for it. That's a lot easier to finance. Now, the last bit of criteria change that's come in from West One, which I thought opened a kind of interesting bit of debate, was that West One are now considering self-employed first-time buyers, first-time landlords, up to 75% loan to value. Now, self-employed borrowers, easy peasy. Every lender lends to self-employed people, so that's nothing to get excited about. But it's the first-time buyer, first-time landlord bit which is more interesting here. So there are lots and lots of lenders who will not lend on a buy-to-let basis if you do not own the home in which you live. It's not all of them. And some lenders will say, we don't mind that you don't own the house in which you live because you live with your partner or you've got tied accommodation with work or whatever the situation is, but we want you to own another buy-to-let. I have asked this question quite a few times of lenders, because sometimes you do sort of think, well, why is this a problem for people? The issue is that as a lender, lenders are very, very nervous about lending where there is a possibility that their borrower is using a buy-to-let mortgage to obtain a property to live in, which they would not have been able to obtain a traditional homeowner mortgage for, because they don't earn enough money. As we know, buy-to-let mortgages, the affordability calculation is driven by the rental income rather than your own earnings. So actually, if I was earning, 25,000 a year, broadly speaking, on a residential mortgage, I could probably about 110, 120. But if I were to buy a property where the rental income would be £1,000 per month, I could probably borrow more like 190, that kind of thing. So actually what lenders are very, very attuned to is making sure that they're not putting themselves in a situation where they're lending on a property which the borrower actually just intends to move into. Now, obviously, if you own the home in which you live in, you're much less likely to be doing this. Likewise, if you are living with family, but you've got a buy-to-let and you haven't moved into it, then actually the reality is that it's quite natural to assume that if you were to buy another buy-to-let, you wouldn't move into that one either. The challenge would be, actually, I've never bought my own home. I don't own the home in which I live. I don't own a buy-to-let. I'm a first-time buyer. So the way that some lenders kind of mitigate this is say, well, okay, we will lend to you, but we're going to treat it in terms of affordability, not just as a buy-to-let, but also as a residential. So we want to make sure that actually you could afford to live in this property in your own rights. Because if that were the case, then you'd be doing on a residential mortgage anyway. So that's kind of the way that most lenders get around this. Now, there are some lenders who actually just blow this theory out of the water, and there's always exceptions, who say, actually, as a first-time buyer, first-time landlord, we will lend to you. We just want to make sure that it's plausible. An example of that would be, I live in Sevenoaks in Kent. I'm a first-time buyer, first-time landlord. I'm buying my first buy-to-let property in 2 minutes from my house. So actually, is there a chance that I'm actually buying it as my home? Whereas actually, if I was the same situation, but I was buying a property in Hull, the reality is that I'm probably not going to be secretly moving into it, because it's absolutely nowhere near it where I live and where my whole kind of life is. So there's a bit of a common sense approach. But there you go. So actually, I just thought those things that West One have brought in, while none of them are kind of earth-shatteringly exciting, they do actually kind of raise some of the things that we come across on a really frequent basis, actually, in terms of lending, which you as landlords might be interested in knowing about. Okay, and lastly, the housing market and what's going on there. So actually, just as an aside, the flat that I've been telling you that I'm trying to sell in Tunbridge Wells for months, I've given up. I was speaking to the estate agent and they just said, look, actually at the moment, the market is really, really tough. The property is getting kind of in the top 25% of kind of views. It's nothing wrong with the property. It's just no one's buying. So we've agreed to put the rent up instead and give the tenant a 1-year contract. I'll come back to it in 2026. So you can look forward to that saga when it happens. But in terms of the housing market, actually looking at the data that I'm seeing here, it's kind of flying in the face of what I'm saying in terms of my own personal experience. And actually, it's not just my experience. There's lots of landlords at the moment who are saying, you know, I want to get rid of this buy-to-let property, but I cannot sell it for lower money. So it's not just a Jeni thing, it's not just a Tunbridge Wells thing. It does seem to be more kind of broad than that. But actually, the data I'm about to share with you paints a slightly different picture. So let's have a look at what they've got to say and have a think about what's going on. So this is based on the latest, I want to say Zoopla, it might be Rightmove actually, I haven't actually saved which report it is, but it's a report from one of the larger sort of estate agency websites. So what they're saying is that the key sort of points are that the housing market activity is unexpectedly high for this time of year, defying the usual summer slowdown. Not in Tunbridge Wells, it's not. Agreed sales are up 8% year on year, a clear indicator of buyer confidence. Buyer demand is 11% higher, supported by changes to mortgage affordability testing. So borrowers using a mortgage can now borrow 20% more than they could 3 months ago. That's a really interesting statistic. So for those of you who kind of haven't paid a lot of attention to this, the good old regulator put in kind of place lots of, let's call them guardrails in terms of borrowing and lending money to people in their homes in terms of affordability. The regulators now said, oh, actually, maybe we were a little bit too kind of mean with this. Let's let the banks be big boys and make some slightly more commercial decisions in terms of their understanding of mortgage performance and their back books and that kind of stuff. So the lenders have essentially been able to kind of loosen slightly the affordability calculations, which means that actually for those buyers who are like, oh, I can't really afford to buy this property, I can't get the mortgage I need, most of these guys are now suddenly seeing that they can borrow 20% more than they could, which is going to obviously really help things. What they then said is realistic pricing is vital as there's a high number of homes on the market. So basically, if you want to sell your property, you're going to have to let it go for a song, I think is the theme there at the moment, because there is loads of properties for sale. So the key takeaways from the report were that buyer demand, agreed sales and number of homes for sale are all at unexpectedly high levels across the UK. The boost in activity is supported by relaxations to mortgage affordability calculations. But house prices, and this is the kind of sort of subheading here, but house prices remain stubbornly low, rising just 1.3% over the last year. So in spite of the housing market gaining momentum, house prices aren't really doing a huge amount at the moment. Price growth has been stunted by the high supply of homes for sale, with 12% more on the market than this time last year. So what we can see is that actually the property market is saturated with properties for sale. They've changed their forecast for 2025, reducing house price growth down from 2% to 1% for the year. So they're actually saying that house prices are only going to increase by 1%. The average house price in the UK is now 268,400 as of June 2025. This is a rise of 1.3% over the last year. Just incidentally, for those of you who are interested, 10 years ago, the average house price was £190,000. So what it goes to show is, and think about what's been going on over the last 10 years with COVID, the mini budget, the global cost of living crisis, all these things been going on. And yet house prices, if you bought a house 10 years ago for 190, it'd be now worth 268. You know, so actually there is still real money to be made in investing in property. In terms of more regional data now, so while some measures of market activity are consistently up across the UK, it's a very regional picture, and this can kind of start to explain why we're maybe seeing houses selling more slowly in certain regions of the UK. So house prices in Wales, Scotland and northern regions of England are rising the fastest at 2 to 3% growth over the last year. In Northern Ireland, it's even greater at 6.1%, and this is due to the low starting point for houses. So what I could sort of read into that is actually for those regions where house prices are relatively low and more affordable, the housing market is still kind of moving really nicely. In the south of England, annual house price growth is below 1%. So this ranges from 0.2% in the southeast in London and 0.8% in the east of England. So where we would have those kind of higher growth numbers in the north of the country, the south and southeast is really kind of holding things back. Price momentum gained in 2024 due to stable mortgage rates and lower stamp duty is now fading, with slower price growth across all parts of the UK. So I think in terms of what's going on here, I mean, I think we've basically covered it in terms of the points raised. But certainly for those people who are trying to sell properties at the moment, it looks to be very, very regional indeed, but it does also show grass shoots of recovery. Fingers crossed for that. Now, in terms of how this is feeding through to rentals, so Rightmove have released their latest rental price tracker, where average advertised rents have hit a record high of £1,365 per month. That's up 1.2% month on month. Outside of London and in London, it's £2,712. So what they go on to say is with 15% more rental properties available in the market than this time last year, landlords are increasingly active again. There you go, guys, you're getting busy, with 28% rise in rental home purchases and a 17% increase in buy-to-let lending. So what does this tell us? That actually are all landlords exiting the market? No, actually we're seeing an increase in landlord activity, and we can see that here at MFB actually. Whereas sort of this time last year, it was 99% of the stuff we were doing was remortgage business. Actually now we're certainly seeing an uptick in the number of landlords who are looking to buy property. Why are landlords looking to invest at the moment with so much going on in the ether? Clearly they're recognising that actually at the moment, house prices, if you can go and get a really good bargain because people are struggling to sell, and therefore you can get your real negotiating hat on there. And then actually we're still seeing an increase in rental yields. And so these two things combined are making it a really, really good time for people to get back into investing. And on that very positive note, I'm going to cut and run for 2 weeks. I'm not here with you, I'm afraid. I've got 2 weeks off work. I cannot wait. I'm going on my first lazy holiday for 2 years. My God, I need it. So I'm not going to be seeing you until the last week in August now. So I'm sure there'll be lots going on. I'm sure the guys in our wonderful marketing team will be keeping you posted in other ways, but you won't have to look at my face for a fortnight. So enjoy the break from that. If you have any questions, despite the fact that I'm not going to be here because I'm going to be sunning myself on a beach in Greece, the office is very open, and I'm not the only broker in the office. There's loads of guys. They're all amazing, really, really knowledgeable, super friendly. Yes, so do feel free to give us a call if you have any questions. 0345 345 6788. And as always, our website is up 24 hours, 7 days a week. So you can catch us on there as well. Do look after yourselves. Have a fantastic fortnight, and I look forward to being back with you in a couple of weeks where we can start to really dissect what's been happening while I've been having a break. Look after yourselves, and I'll see you then.